Today on the podcast, we have two very interesting speakers who have unique perspectives on a topic that has been around for a while and is heating up: Brexit. First up is Helen Thomas, CFA. She founded her macroeconomic consulting firm, Blonde Money, in 2017. Before that, she was a partner at a global macro hedge fund and head of currency alpha for State Street Global Advisors and other Forex desks prior to that. She was an advisor to former Chancellor of the Exchequer, George Osborne, during the financial crisis. She is also on the board of our fellow CFA society, CFA UK, and earned her degree at Oxford. Ron Dickerman is the president and founder of Madison International Realty, a global real estate private equity firm which has raised over $5.4 billion in capital commitments. His primary responsibilities at the firm are investment strategy, capital formation, and risk management. Before Madison, he was president and founder of First Equity Realty. Earlier, he was an investment banker in the real estate partnership finance group at Smith Barney, Harris, Upham & Company. He earned an MBA from Columbia's University Graduate School of Business and a BA degree from Tufts. So with that, Helen, could you give us your view on what is cooking with the political discussion there as we run towards the deadline?
So, of course, we are now hitting a period of peak outrage, is kind of how I would describe it, because where we're in a slightly different position at the moment versus the previous deadlines of March and April, this deadline of October 31st is different, and that is because of the opinion polls. So the last extension hit both the Labour and Conservative parties badly in the opinion polls. They both lost a lot of seats in the European parliamentary elections that took place in May. There has clearly been a almost existential problem for the big two main parties because Brexit is not yet resolved. So although there is some legislation in the pipeline to try and get another extension, actually it is not necessarily in anybody's interest for that extension to take place. So we have a different scenario in terms of the extension, but the really big question, I guess, is are we going to leave on October 31st at all? And I would tell you that the Prime Minister himself has been very clear, repeatedly telling us we will be leaving, deal or no deal. He even made this comment of how he would, quote, die in a ditch if it didn't happen.
Right.
Now, of course, politicians say many things. Things can change at the last minute. But I would also add there's been a huge public information campaign here with adverts on billboards, radio, TV. Get ready for October 31st. This commitment to delivering is one that, if we add that into that opinion poll point, if Boris Johnson does not deliver this Brexit October 31st, he could well be out of a job. So we are now into, as I say, the crunch period, and there is a lot of high emotion and a lot of outrage and anger and stress going on right now.
So I realize this is a little difficult, but how likely is an extension of the deadline, and what would it mean, and what would the political ramifications mean?
So at my consultancy business, we have approached this question as analytically as possible, which is that a year ago, we created a database of all the 650 MPs, and we ranked each of them on 23 independent criteria to get their personal views on Brexit. And at that point, even a year ago, it was very clear to us that it would be almost impossible to get a deal that would pass through Parliament. That, clearly that is where we're still at now, a year further along. So the question really is, what would be the point of an extension? There's talk of having an extension to get a deal, talk more to the EU, but of course, discussions have been going on for 3.5 years. So given that analysis, and those numbers are well known within the UK Parliament, there is also the point that Boris Johnson is Prime Minister. He, if I talk again about the opinion polling, since that extension, there has been the rise of the new Brexit party, Nigel Farage's new version of what he had with UKIP, which did very well. until Boris Johnson started to take over and say, well, we will be leaving and we will deliver Brexit. So again, this is important to look at the numbers in terms of what suits each party. And the truth of the matter is that a no deal exit suits a lot of parties individually, even if on an aggregate economic basis, it may not be all that good for the country. So when we talk about this issue of the likelihood of an extension, we would add our analysis of the MPs' personal opinions, plus the opinion polls and the fact we are headed for an election soon. And we would say the truth is that an extension is no longer costless to anybody. So actually an extension is quite unlikely. Despite the fact there has been some legislation passed, it is actually quite unlikely to happen. So our base scenario would be leaving October 31st with no deal at 75% probability. There is about a 15% probability that at the last minute, people blink and a deal can get done. And then the remaining 10% is this idea of an extension being passed.
Interesting. So Ron, perhaps we can switch to you and take a step towards the impact on the commercial real estate market since the referendum to the near future.
Yes, I'd be happy to comment, and thank you so much for having me. We have quite an interesting perspective at Madison, and maybe just 10 or 15 seconds of background. We have tried to use sort of geopolitics and global volatility to uncover investment opportunities, understanding that the real estate markets and the markets in general tend to be cyclical, and capital ebbs and flows, based on some of these themes that I'm describing. So maybe just to tell an interesting anecdote, we've had a habit at Madison of putting ourselves on the ground at moments in time that might create investment opportunities. And to give you a little bit of a sense of that, I remember being on the ground in Riyadh, Saudi Arabia, when oil prices hit $26 a barrel. I remember being in Tel Aviv when Benjamin Netanyahu was giving his speech on the floor of the U.S. Congress to try to torpedo the Iranian nuclear deal. And I specifically went to London for the original Brexit vote in June of 2016, when the referendum was being voted on with many members of my senior management team. And just to tell kind of an interesting anecdote, I remember having meetings leading up to the Brexit vote. It was a Thursday in June of 2016. And I remember it like it was yesterday, as I'm sure everyone does, meeting with CEOs of public and private real estate companies about the potential of Brexit, the referendum being passed, and what impact it might have. And you might remember the real estate market was going gangbusters. There were cranes in the sky, and there was a lot of talk about overheating and overbuilding of the London real estate markets. And I remember, asking the CEO specifically about the potential impact, and the view was, well, don't really think Brexit's going to happen, don't think it's going to bother us, really isn't something we're putting a lot of time into. On the other hand, the polls were dead even. You remember it was 51-49, and no one knew exactly which way the referendum was going to go. And I remember then getting into the taxi cab at the end of the business day, driving back to the hotel, and the taxi cabs were mad as heck. They didn't want to take it anymore. And it was quite clear that this was a political issue, not so much an economic issue. And I'm not sure that so many of the voters understood exactly what they were being asked to vote on as it related to Brexit. So I remember being out to dinner on that Thursday of 2016. The polls were announced, Brexit is approved, the UK is leaving the European Union. And I remember waking up Friday morning, scratching my head, seeing the UK listed property markets tank about 25 to 30%, and David Cameron got on television and resigned. And that was quite a dynamic and shocking moment. And I think everyone then sort of dug in to trying to figure out what exactly does Brexit mean. And as we all know, we've had so many twists and turns, over the last 3 years. It's been rather dramatic. So in terms of the impact on the commercial real estate markets, capital has gone to the sidelines for many, many months. I think institutional investors around the world viewed the UK and London specifically as not investable. And a lot of development projects that were on the books were effectively canceled. And the market in some ways has self-policed itself. On the other hand, the US economy has been strong. Europe has been relatively robust, although maybe going into a little bit of a slow period now. And that momentum has carried the UK forward. And with some unintended consequences like the fall of the British pound, I remember just before Brexit, you were talking about 1.4, 1.45 to the US dollar. Now this morning, you're at about 1.24. So that's been a little bit of an unintended consequence and a boost as it relates to the attractiveness of UK goods, on the world markets. And the fact of the matter is, the UK property market has been relatively slow and steady. There has been, relatively muted take-up velocity as it relates to leasing. A lot of the development projects that were on the books have actually continued to lease. There has been a fair amount of transaction activity involving trophy quality London office buildings that have been bought by Asian sources in more of a flight to quality and safety. And I think there's a lot of chatter right now about, the political transition, the winds of change, hard Brexit. And in my opinion, Brexit has evolved from a political issue to an economic issue. And I think, we believe it's relatively unlikely that Boris Johnson or anyone are going to sort of cut off their nose to spite their face. And I think they're going to act in kind of a rational way. And if you don't mind, I'd just like to read a quote from Boris Johnson that appeared this morning in the Wall Street Journal, which tells a really good story. And the quote is as follows. It says, "The way to get our friends and partners to understand how serious we are is finally, I'm afraid, to abandon the defeatism and negativity that has enfolded us in a great cloud for so long, and to prepare confidently and seriously for a no-deal outcome," quote unquote, said Boris Johnson. And I guess what that means to me is the criticism of Theresa May has been perhaps, not being strong enough with the European Union on the ability to affect Brexit. But given all the potential impact, I think there was an estimate from the Chancellor of the Exchequer that a hard deal Brexit could cost over $100 billion in lost revenue. And there's just so many intricacies in the union between Europe and the UK. It just seems to us that has to be worked out. So we're very optimistic that a hard Brexit is unlikely, although we are prepared for such a thing. But getting to the punchline for Madison, we've been investing in London for the last 3 years relatively aggressively. It was announced about 6 months ago that we've taken an ownership stake in a company called Capital and Counties. We've invested in a transaction called Wellput, which is the West End of London Property Unit Trust. And our view is London will always be the center of the world. It will always be the center of sort of flight to quality and safety. And it really acts as a gateway. So from our perspective, we're taking a 5 to 10 year view, and we're still very, very optimistic. And we think that if you have a similar view, London continues to be a place that institutional investors around the world should be investing.
All right, I see. So you all took the view that the freezing of the market, or the freezing of investments in the market, I should say, was the type of issue or uncertainty that leads to a positive investment opportunity for those that can take the risk.
That's exactly right. That when capital runs to the sidelines, volatility creates opportunities to buy quality at attractive prices. And the frothiness that existed in the London market leading up to the original referendum was frankly a little bit troubling, just as it relates to the amount of speculation. And the Brexit referendum has acted as a little bit of a check valve and sort of a pressure relief in a marketplace that we think is highly resilient. We are concerned about the possibility of a hard Brexit, but we feel as if the possibility is relatively low, and that cooler heads will likely prevail.
Okay, well, let's drill down into that for a second. You've spoken a lot about London. Do you have the same view of investments in other of the larger cities in the UK or even some of the smaller locales?
Well, it's funny. We tend to want to invest in more capital cities. We invest in gateway cities of the U.S., London, and Western Europe. So at this point in time, we're not investing in some of the second-tier cities of the UK. We think as it relates to risk return, they're more likely to be more significantly affected by a hard Brexit. And I think the way that we're trying to risk mitigate, the overall probability is by sticking to, quality institutional sort of Class A assets. And at this point in time, we're focusing only on London.
Okay. In your analysis, do you see other sectors outside of the commercial real estate market that could be pressured by Brexit?
Yes, absolutely. In it, we have seen more and more information in these last few months about what the world could look like after the 31st of October, or at least what it will be like once the UK actually leaves the European Union. And there have been these no-deal preparation documents. We hear new tariff regimes. We hear about processing of regulatory requirements at the border. All of this will clearly have an impact on sectors that are highly involved in the import-export business. And therefore, we would flag up food and drink, clearly one that could struggle because, you cannot just ship over or wait to get your lettuce leaves from Spain, or, it doesn't keep all that well if there's any kind of delay to getting the goods across the border. But also two other big sectors. I mean, the first is the automotive industry, because just-in-time manufacturing means that supply chain demands, the supply chain timing is very much shorter than it ever used to be. The world has become very globalized, very efficient. There's no need to build and store inventory in huge warehouses. If you can just get your parts in from Germany, Romania, France, wherever, and put them into the factory in the UK, that will change significantly, again, if there's any kind of delays at the border. And then the other really big one after food and drink and automotive will, of course, be financial services. Which, of course, to the listeners to this podcast will be dear to their hearts. A lot of steps have been taken, as I'm sure people will know, with the big multinational organizations in terms of establishing physical offices in places like Dublin or Luxembourg to ensure access to the EU markets. But there, will still be some difficulty with marketing and distribution of funds across, the EU-UK border. There will be lots of question marks about regulation. However, it's the one sector that I would hope would be pragmatic and sensible in terms of managing any disruption that falls from that.
Yeah, that is maybe a good time to shift to the longer term view for all of these sectors. Ron, I know you've already said that you all have positioned your portfolio for a longer term thing. Ron, maybe one of the things I'm curious about is in your forecast, what could go wrong? What do you see as the risks to your 3 to 5 year goal beyond just the regular old cyclicality of the market?
Right. Well, maybe a couple of things, and let me just make a comment about one of the conversations we were having earlier about a second referendum, which we find some irony in. That one of the things which is the case in a democracy is you have to live with votes as they occur. And I think this has been something that we would commend Theresa May about, is that her view has been, how can you have a democracy when if you just have a standard that if you don't like the vote, you simply vote again. And I think from our perspective in the United States, you can't have a democracy on that basis. So we believe, in that irony, that there really isn't a rationale to have a second referendum. So from our perspective, we think, that the UK should hold, their people and their democracy to a similar standard. coming back to your question about, sort of what can go wrong, there's many, many things in the world today that I would call, black swan possibilities, from, North Korea to Iran to other things in the Middle East to, just kind of stock market issues being toppy to the, sort of the tech boom. But we see a very stable runway right now as it relates to monetary policy. The U.S. Federal Reserve, I think, is acting very, very responsibly, having, sort of stepped away from, what they thought were 3, maybe 4 interest rate increases. The European Central Bank is talking about quantitative easing and potentially lowering interest rates because of, some economic news that's sort of coming out of Europe. So from our perspective, we think that the risks, sort of the 3 to 5 year risk, really has to do with some of the geopolitical hotspots around the world. And our view is sort of economic expansions don't die on their own. They die out of restrictive monetary policy or some type of events going on with currencies or, capital markets and things of that sort. So we're relatively bullish, and we continue to watch those indicators closely. And I think, from our perspective in the property markets, things are quite different now than they were back in 2007, where there was a lot of over leverage. There was, kind of a frothy sort of buying frenzy on underwritings that really didn't make economic sense. And at the end of the day, it was really the housing market that brought the real estate property markets down. And clearly we see a lot more health, in that sector. So I would say that we're relatively bullish.
Helen, do you share any of those long-term risks? See others?
I think I would absolutely pick up on some of those risks there about volatility and how that might affect the structure of the market. We've had all of this volatility suppression for a number of years, which inevitably at some stage does build up to a bubble that bursts. But I want to talk specifically about the UK and kind of get back to this concept again of us being a rational, sensible nation, which I applaud and I'm very happy to hear. But the political setup now is we're facing probably the most volatile political outlook for 40 or 50 years in the UK. We've had a new party has been created. 2 new parties have been created, in fact, since the Brexit deadline was passed. And what that means is that, of course, we're supposed to have quite a stable 2-party government. It's similar, of course, to yourselves in the United States. I think the most fascinating thing about the politics on your side of the pond is that the cleverest thing Trump ever did, and I'm not sure he knew he was being clever, but he effectively ran like an independent candidate within the Republican Party machine, which of course meant he could be much more successful than people like Ross Perot or indeed, Tea Party candidates, etc. So, you have to respect the institutional framework, and Britain has a similar one in terms of we usually are a 2.5 party system, but we now have 4 parties. This is unprecedented, and it leads to unstable coalition governments, which are not supposed to happen in a first past the post electoral system. What that means, without getting bogged down into the political detail, is that we are going to have more minority governments. We're going to have governments that don't always agree. They may be much shorter in term. They may be able to do a lot less. It also means that we have a polarized electorate, and the parties become more polarized. They try and grab more of the left or right ground. And what I think we're going to see in these next 5 to 10 years, which will be unusual for Britain, is we will see a switch from one extreme to the other and back again. So whereas usually you have historically long periods where there might be the Labour Party in control and then a long 10, 15-year period of the Conservative Party being in control, we may have 1 to 2 years where we go over onto a very hard Brexit Conservative government. But after that, we flip to a Remain-leaning, left-wing economically, very socialist Labour Party-led government, and back again. And that will create a very volatile regime for investing because, I don't know how many of your listeners have looked into what the Labour Party are trying to do in Britain, but there's talk of mass nationalisations, huge ramping up of the deficit, abolishing tuition fees, increasing a minimum wage, a very strong left-wing socialist agenda, which would create a very different kind of economy, than the centre-right economy that we've had a stewardship of for the last 10 to 15 years. In fact, for the last 30 years. So all I would say in terms of risks on the long term is that Brexit is actually just one dimension of what we anticipate to be a very volatile political period, which will lead to differences in tax regimes and will lead to a very different way in which our economy is run. And therefore, I don't like to say this, but it will create an unstable investment world, and one in which getting back to this point about British people being rational, we may look quite irrational for some time to come, unfortunately.
So if the rationality dividend declines, then how does that factor into the commercial real estate market? Is that, so obviously because there could be an impact on growth, right? If there are planning issues, that could have an impact on growth. But are there other ways that are less obvious that it could circle back to the real estate market?
Do you want me to say that or Ron? I think Ron's the
expert.
Ron, you're the expert. I know that's not your view, Ron, by the way, and I hope that your view is the right one. But it's my fear that we will get this volatility ahead.
Yeah, and I just want to be clear that we are absolutely prepared for a hard Brexit and feel as if the risk mitigants exist by focusing on London as sort of the central real estate market of the UK and quality. We also have overlaid several tactical tilts on our strategy, which include longer lease duration. In other words, not taking operating risk or leasing risk in the near term, which is exactly what would be the biggest disadvantage of a hard Brexit, and also focusing on cash flow and current dividend yield backed by the leases I just described. So from our perspective, there is absolutely downside risk, as it relates to a hard Brexit scenario, on things like lease up velocity, rental rate growth, cost of capital, just because access to capital would be significantly reduced in the context of a hard Brexit. So anyone investing in the UK today has to have that as a potential scenario and going in eyes wide open. I think from our perspective, we're well aware of the stalemate that's existed in Parliament and the fact it's been so difficult to work through this whole Brexit morass. In my opinion, it's been somewhat of a waste of time, and it's been really unfortunate that the UK has spent so many resources on trying to weave its way through the Brexit referendum that happened almost 3 years ago.
Agreed. So, all right. Well, this is interesting. So, just to summarize, the political volatility could rise. One person on the call here is quite positive on the long-term commercial real estate possibilities in the UK. Ron, your risk mitigation techniques sound very interesting, and I think that we're all going to go run back to our Bloombergs now and look for the rationality dividend. So thank you both for being on the podcast. This is an awful lot of fun, and I hope we can have you back again sometime soon.
Thank you very much.
Thank you so much, Rob and Helen. It's been a pleasure to be on with you.
I hope you enjoyed our podcast. If you have not yet, please subscribe at the podcast app of your choice. Also, please visit us on the web at cfany.org.